Supply and demand zones are some of the most basic formations that we see on our charts. However, they're still powerful enough that we can use them on their own without any other trading indicators to find and execute profitable trades. In this video, I'm going to break down exactly what supply and demand zones are, give you some tips and secrets about supply and demand zones, and explain to you exactly how you can get in and out of your trades using solely these very powerful levels on our charts. So what exactly are supply and demand zones? Supply and demand zones are essentially just areas of resistance and support due to supply and demand imbalances. Supply being the sellers and demand being the buyers, these two things are really the sole reason that we see price fluctuations in the market. Many people think that it is, things like news, press releases, earnings reports, different chart patterns. And while those things may influence the supply and demand itself are going to be what actually causes the prices to change. So if we can use these areas on our charts to see where there is more demand than there is supply, in other words, more buyers than there are sellers, we can also then get in on that buying, which is going to help us buy low and then later on sell high for our profit. Take the chart for Bitcoin here, for example. We can see that up in the $24,000 to $25,000 area, there are several candles that kind of peak in the same area, and when they peak, they form these long upper wicks on those candlesticks. And for those of you that know a thing or two about candlestick analysis and candlestick trading, a long upper wick or a long upper shadow represents that the sellers are taking control. It tells us that within that candlestick, the stock price spiked up, but the sellers were able to take control and drive the price back down before that candlestick closed. So that area is going to become our supply zone for Bitcoin, and we can see that there is a pretty steep sell-off to the downside from that area. It then pulls back into a level where the price previously bounced from in the $18,000 area. And once it gets back into that zone, we can see that pretty much the same thing happens then with the lower wicks on these candlesticks, forming a lot of long lower wicks, telling us that the demand in that area is much higher than the supply. That's going to become our demand zone, and we can see that the price then starts to rebound from that area and is now starting to pick up some momentum to the upside. Now, one thing that a lot of traders don't know, even a lot of those that regularly trade supply and demand zones, is that you want to pair these supply and demand zones to the overall trend of the stock or the ETF or the contract or the cryptocurrency or whatever it is that you're trading. So you may have heard the popular quote, "Don't fight the trend is your friend." And that still needs to be applied to supply and demand trading. And what I mean by this is if the stock is clearly in a downtrend, it's making lower lows and making lower highs, you don't want to try to buy into these demand zones thinking that you're buying in at the exact bottom of this downtrend. Instead, you're going to be much better off by short selling into supply zones and then covering your short position into any demand zones below. By doing this and by going with the overall trend, it's going to make it a lot easier for you to actually time your entries and your exits on your trades. The same is true obviously for an uptrend. When there's upward momentum and the stock is climbing higher and higher, you don't want to try to short sell into these supply zones thinking that you're going to nail the exact top of the short. Instead, look for a pullback into a demand zone and use that as an opportunity to buy the dip. Now, not to state the obvious, but stocks are not always going to be in a clear uptrend or in a clear downtrend. Sometimes they're going to trade sideways in a consolidation zone or in a price channel, and that can happen for an extended period of time. Now, that doesn't mean that you're unable to trade these stocks because at the end of the day, you wouldn't be fighting the trend by buying into demand zones, and you still wouldn't be fighting the trend by short selling into supply zones. So when you find a setup like this, you're actually going to be able to capitalize on both sides of the move by going long into demand zones and by going short into supply zones. Now let's take a look here at the daily chart for BTU. BTU was a swing trade that we nailed in the Market Master group in the past. Our buy alert was put out to our team here as it was pulling back into this demand zone, and we could see that it bounced all the way down from a low of $18.35 up to then a high just a few weeks later of $29.14. So there was huge return potential just from swing trading this demand zone. And the beauty of it is that you can repeat this process over and over and over until it gets a breakout to the upside or a breakdown to the downside, because as we can see here, With BTU, there is not a clear trend in either direction at the moment. It's trading sideways in this consolidation zone, which means that we can buy into demand, and then we can also short sell into supply. So going all the way back to May here, we could see that we would be able to buy into this demand zone at about $20 per share, and then sell up here near $30 per share, flip over to the short side, and then profit again from this pullback into demand. Repeating that over and over, making money on both the upsides and the downsides. Now, because nothing works 100% of the time in the stock market, that is also going to be true for supply and demand zones. Occasionally, you're going to see a false breakdown below a demand zone, and you're going to see a false breakout above a supply zone. A lot of inexperienced traders think that if a stock is moving above a supply zone, that it's automatically going to be considered a breakout, and that breakout is going to then turn into an uptrend or a run to the upside. While that may be true sometimes, a lot of times there are going to be false breakouts. And these false breakouts are what cause a lot of traders to buy into the high of a move before it comes back down below that supply zone and ends up selling off to the downside. The same thing happens a lot of times with a demand zone. Traders assume that the demand zone is going to hold as support. The price briefly breaks below that demand zone, causing them to cut their losses and get stopped out of their trade, and then it will reverse right back up and end up spiking to the upside. So in that case, not only did the trader get stopped out and take an unnecessary loss on the trade, they also then missed out on the potential profit that followed after the false breakdown. So I bring this up to say that even though risk management is very important with stock trading, it's going to be even more important to manage your risk properly. My tip to avoid getting stopped out in these false breakdowns would be to give your stop loss some kind of room below the demand zone that you're basing it off of. So if there's a demand zone, let's say at $1 per share, you don't want to have your stop loss set just at 99 cents per share, because that's going to make you very vulnerable of getting stopped out on a false breakdown and missing out on a potential run. Now the $1,000,000 question is, how much wiggle room do you want to give your stop loss? And that is really going to depend on the type of stock that you're trading. Let's go ahead and take Apple, for example. Apple is currently trading at $137 per share. So if you think about it, a 1% move in Apple would be $1.37. $1.37 is plenty of wiggle room below a level of support or below a demand zone to use for your stop loss. On the other side of the spectrum, let's go ahead and take a stock like VERU, for example. VERU is one of the top percent gainers for today. It is spiking up, and it's up about 48% for the day, and it's currently trading just above $15 per share. So a 1% move in VERU at $15 per share is going to be just 15 cents. Now you can see how 15 cents is obviously much smaller than the example with Apple, so using a 1% stop loss on a stock like VERU is going to make your odds of getting stopped out on a false breakdown much higher. So for VERU or any other highly volatile stock, you would probably want to look to use a stop loss maybe around 5%, and sometimes with very highly volatile stocks, your stop loss may be upwards of 10% from your entry price. Now that doesn't necessarily mean that you should be risking way more money on a trade with a stock like VERU as opposed to Apple. When you find out where your risk level is going to be and where your stop loss is going to be placed, you should use that to determine your position size for that trade. And if you know that, for example, your maximum loss that you want to take on any given trade is $100, while you're trading a stock like Apple and using a risk of 1% from your entry price, that means that realistically your position size can be up to $10,000. On the other hand, if you're trading a stock like VERU and your risk level is going to be 5% away from your entry price, in that case, the most that you would want to invest into this stock would be $2,000, because 5% of $2,000 is your maximum loss of $100. Okay, so hopefully having watched this video, you can see that even though supply and demand zones are very simple levels on our charts, they provide us as traders a ton of valuable information, and we can use them not only to find our entries and exits on certain trades, but also to manage our risk and to find the ideal position size for any given trade. Hopefully you found some value in this video, and if you did, please make sure to give it a like and subscribe to the channel. And if you want to learn more about day trading, swing trading, and long-term investing, and join us in our daily trading group, you can find more information on that at my website, Master the Market, which will be linked down below in the description. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading.